following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes.
This is the Options Industry Council's Wide World of Options. Before we start today's show, investors should know that options involve risk and are not suitable for all investors. You should not enter into an options transaction until you have read and understood the risk disclosure document, Characteristics and Risks of Standardized Options. This brochure is available by visiting www.optionseducation.org or by calling 1-888-OPTIONS. OIC makes no recommendation with respect to any financial firm. OIC does not make any warranty as to the accuracy, usefulness, timeliness, or the continued availability or existence of information created or maintained by others. Multiple leg strategies involve multiple commission charges. Opinions and strategies expressed by others are not necessarily those of OIC, nor does OIC endorse, warrant, or guarantee products, services, or information described or offered by such firms. Commissions, fees, margins, interest, and taxes have not been included in any of the examples used in this show. These costs impact the outcome of all stock and options transactions. Consult your tax advisor about any potential consequences. None of the information presented in this show should be construed as a recommendation to buy or sell a security or to provide investment advice. Welcome to the Options Industry Council's Wide World of Options. OIC was created in 1992 to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. OIC offers a variety of resources to those interested in learning more about options, including live seminars, webcasts, and podcasts. Check out www.optionseducation.org for more information. Now here's your host, OIC's Director of Retail Education, Joe Burgoyne.
Welcome to OIC's Wide World of Options. Thanks for joining us for today's show. Let's get started with industry happenings.
It's time to get a handle on the latest developments from the world of options. It's time for industry happenings.
We're going to talk about exercise and assignment in today's industry happenings. These are not new concepts in the option space, but I thought it might be useful to review exactly what they are. Exercise is the actionable right that an option owner purchases when he or she buys an option. Now, depending on if it's a call or a put, the right to exercise gives the buyer the ability to buy stock at the strike for a call and sell stock at the strike for a put. The option buyer pays some price for the option, and with that purchase comes the right to exercise the option. Options are American style, meaning they can be exercised at any time until expiration. There's also a European style, which means they can only be exercised on the day of expiration. Most options traded on the exchanges are American style. Now, the flip side of exercise is assignment. Assignment can be viewed as a potential obligation required of the option seller. Because option sellers collect premium as opposed to buyers who pay premium, they are subject to this obligation to deliver stock at the strike when assigned. That is, when they are told by the clearinghouse they must deliver the shares at the strike price they had sold with the option. Buyers of options pay a premium for the right to exercise their options. They're in control. Sellers, on the other hand, collect premium. They take on obligations and are not in control. Finally, remember, the majority of option positions are closed out prior to expiration, before exercise or assignment. That's our review of exercise and assignment in today's industry happenings.
It's time to meet the movers and shakers from the world of options. It's time for Profiles and Perspectives.
Joining us today on Profiles and Perspectives is Shelly Brown of the new Miami Exchange. Shelly, welcome.
Thank you. Glad to be here.
Thanks for taking the time to join us today. Before we get into some of the details about, the new Miami Exchange, how about if you tell our listeners a little bit about, your history in this wonderful industry of ours?
Sure. And it is a wonderful industry. It's kind of a funny story how I got started in the business. Met a guy playing golf literally one summer. He was a trader on the SIBO.
Right.
And he invited me down to the floor. I expressed interest. It sounded like fun. I knew nothing about options. And called him the next day. And that Thursday, went down. He brought me down to the trading floor, had me stand in the crowd with him. He unwound his positions before we went to lunch. And that 10 minutes I was standing in the crowd, it's like I had an aura come over me. This is the coolest thing I've ever seen, and this is where I'm going to spend the rest of my life. I was hooked, literally hooked that moment. We went out for lunch. We came back to the floor. He introduced me to a few people. At the end of the day, I was interviewed by Chicago Corp and offered a job as a runner, and I started the following week.
Fantastic. Fantastic. Now, what year was that?
That was late 1980.
Okay, fantastic. Very close to the time I started myself. And why don't you tell our listeners, what's a runner?
So back when we still had trading floors,
there you go.
The brokers were in the crowd with the market makers, and the orders were all phoned in to phone clerks in booths, and the runners were responsible for taking the little pieces of paper with orders to buy or sell specific options and literally running them out to the trading crowds, to the brokers, waiting to either get a market back or get a fill and take it back to the booth. I took the
technology at its finest.
Yeah,
huh?
Technology at its finest. Exactly right. I took the job very literally. It took me about 2 weeks before I was threatened to be thrown off the floor. One of the floor officials that finally grabbed me by the scuff of the back of my neck, he said, "You're like a boat going through the water, except the wake are people. You're going to kill somebody." My boss took I got a $100 fine. My boss took the fine, said, "I don't care how many of these you get, just keep doing what you're doing." I was a pulling guard, so.
You were running and getting those orders, to their designated location or pit, huh?
Absolutely. Nothing stopped me.
Fantastic. Well, here we are now, 2013, and we've got the latest entrant to the listed options space in the Miami Exchange. How did you join Miami? And, tell us about that.
Sure. So obviously I've been in the business a long time, since 1980, and have been in several different parts of the business. I started trading in 1981 on the CBOE floor, traded through to the early 90s, started a little software company. We're doing handheld trading systems for traders, and had an opportunity to join a large market-making firm in Philadelphia, Susquehanna.
Heard of them?
Yeah, you may have heard of them. And while I was at Susquehanna, I met Doug Schaefer, who was in technology at Philex, and we worked very closely together. And
heard of him also.
Number of projects, and an opportunity had come along at that exchange, at the Philly Exchange, before they were bought by NASDAQ, for me to join the team there. It was a different opportunity for me, and I thought it was a great opportunity to be on the business side at an exchange. And I was with NASDAQ for about 5 years. Found another opportunity and moved on, and then got a call from Doug about a new opportunity that he was looking at, and that was MIAX. And we got together and talked about the opportunity to build an exchange the way we thought it should be built, from both a technology standpoint and a business standpoint.
And when was that?
That was in March of 2011.
Okay.
And sounded like a great opportunity, and I decided to make the move. And I know Doug and I work very well together, and thought the idea of his business and technology mind and my business mind, that we could put something together that was really special.
Yeah, Doug is he's a big part of the technology behind the scenes there.
Absolutely
right?
is. He's our CIO, and he and his team are the brains behind what is now, in my belief, the best options trading exchange system in the world.
Well, you just got started in the last couple months. I heard you say yesterday that you're up to over 600 underlyings now.
That's correct.
Tell me a little bit about maybe a few milestones and just a little bit of the formation of MIAX.
Sure. We were working on the Form 1 and the rule filing throughout last year. We received our approval as an SRO in very early December 3rd to be exact. We launched on December 7th with one symbol, ran with one symbol for a couple of weeks, added a couple of more symbols. Once we got into January, we added an additional 20 symbols, and we were up to over 100 symbols within the first 3 months. And the last 2.5 months have been the aggressive ramp up of the larger classes.
Now, do you, I think we
make markets in about 3,700 products, something like that. Do you envision, having options on all of those underlyings?
Well, if you told me as part of that I could also get SPX and VIX, heck yes. The reality is I wish we had access to some of those products. Obviously, we don't. We don't currently envision listing all the equities. The top 600 names are approximately 95 to 97% of the overall equity volume. That's where our target is right now. Certainly, if volume picks up, that it becomes economically viable to list the next 2,000 classes or 2,500 equity classes, if they're really trading, we would consider doing that. We certainly have the throughput. We certainly have the capability. But right now, our focus is on that top 95%.
And how about your clients? Who do you reach out to as your client base?
So we are a pro rata model.
Right. Okay. Now, let's explain exactly what that means for our listeners, because a lot of the listeners, know that there are different, models at the exchanges, but tell them what a pro rata is.
There's two primary allocation models used in the options markets in the U.S. One is pro rata, the other is price time. In a price time market, best price obviously always has the first ability to trade, but then at a given price, whoever was in line first trades first. If their size is exhausted, you move on to whoever was there second and on through the line, kind of first in, first out.
Price time.
That's price time, exactly.
Yep.
In the pro rata model, price is still paramount. Obviously, whoever's at the best price always goes first. If there's multiple participants at the same price, there's a carve out for customer orders. Customers always are in the front of the line. And then the next group of participants is based on a pro rata allocation. So each individual size divided by the total size, and you get that percentage of the incoming liquidity.
Okay. Now, there are other exchanges with that same model.
That is correct.
Okay. How does the retail investor benefit, with Miami?
The retail investor benefits in a number of ways. First off, the pro rata model encourages deeper liquidity. If in a price time model, somebody sets the price, somebody puts a 2 bid up on the screen for 100 contracts. If I join that 2 bid, I'm behind that 100 contracts. If somebody in a pro rata model puts up a 2 bid for 100 contracts and I join as a 2 bid for 100 contracts, I now get access to 50% of the liquidity at that price. If a third person joins with another 100 contracts, now we would split it 3 ways. What it does is it encourages deeper markets, more volume at each price point. So that's where the model advantage comes to the customer.
The investor. Okay, very good. I read some of the other things you're doing at the exchange. You're talking about a futures exchange, an equity exchange. Do you have a time frame? What are your thoughts on that?
We don't have a specific time frame.
Right.
We certainly plan on launching both a futures exchange and an options exchange down the road. Right now, we're focusing on the options exchange. We thought that was the right market to go after initially for a number of reasons. One, we believe the margins are reasonable. 2, it's our area of expertise. We've done it before, and we knew we could do it again. But the equity markets and the futures markets will come once we complete the full build out of the options exchange. We still have additional functionality to build on the options side, things like a price improvement mechanism, a crossing facility, and of course complex orders.
Yeah, let's. Why don't you go through each of them just and kind of explain what they are?
Certainly. So a price improvement mechanism is an ability for a firm to introduce a customer order into an auction whereby the customer can potentially receive price improvement over the displayed NBBO price.
NBBO being National Best Bid Offer?
That's correct.
Okay.
That sort of functionality is in place at several of our competitors, and it's very, very popular for the smaller retail customer.
Makes sense.
It's always nice to get price improvement for the customer.
Indeed. Now, you mentioned a couple other functionalities, complex order book and one other.
Crossing mechanism. Again, several other competitors have a crossing mechanism. It's more for block size orders. generally 500 contracts or larger. If a customer enters an order in a relatively illiquid market, their firm may decide to commit their own capital or reach outside the firm to find other firms to commit capital to facilitate that trade, and then it's entered into a crossing mechanism, which is another sort of auction. There's also the potential in that auction for price improvement and additional participants to join the market.
Very good.
And the complex order mechanism is, of course, a combination of multiple options traded in net debit or credit, or options with stock.
Right.
Again, a lot of the popular strategies, a lot of the hedging strategies involve complex orders. It is said that 20 to 30% of the option volume on any given day is done in the complex order market. So it's a market we want to enter to be competitive, but it's also a market we think we can enter and improve upon the process.
I think your offices are down in Miami, is that right?
Our offices are not currently in Miami.
Okay.
Well,
Princeton as well?
We like to call it Miami of Princeton. Yes, we're located in Princeton, New Jersey. Once we open the equity exchange, the marketing sales and listings arm for the equity exchange will be located in Miami, as well as another future project, which is technology sales. That'll be headquartered out of Miami as well.
Okay. Well, I hear conversation about interest in Latin American business, and so the whole Miami thing kind of makes sense. What's the drive behind Latin America?
Well, we believe it's an underserved market. There's an opportunity for Latin American companies to list their security in the U.S. It gives them access to more capital and the stability of the U.S. financial system. And there's such a large Latin American presence currently in Miami. It has attracted a lot of Latin American entrepreneurs, and it's a city that's done very well building itself as a medical hub and a research hub. And we believe that there's interest in it being a financial hub as well.
Very good. Well, good luck with that initiative. Any other things you'd like to talk about before we wrap it up?
Well, it's been an interesting experience putting together a new SRO, to say the least. But what's really been fascinating for all of us, when we first put our plans together approximately 2 years ago and laid out our market model and started the design of the system, we had targets we wanted to reach in terms of throughput and speed. We're big fans of helping the entire tide rise and the whole industry doing better. So we set out on a set of technological targets for throughput and speed for both orders and quotes. We've actually exceeded those goals. The throughput on the system for both orders and quotes is many times larger than would be needed today.
That's a good thing.
It is a good thing. It allows us for plenty of future growth. The speed is incredible. Obviously, I don't have access to the speed numbers at each of the specific exchanges today, but the numbers that we are seeing are far better than the numbers we have heard other exchanges are producing. We did have a data point, I believe it was the Singapore exchange, that rebuilt their system last year at a very high cost. And the throughput numbers that they were publishing, which at the time were considered fastest in the world, we've beaten those numbers as well. We're literally measuring things in double-digit microseconds.
Remarkable.
For those of us that came off the trading floor, it's mind-boggling. But we also
especially the runners.
Yes, exactly. I wasn't the fastest, but I could get through any crowd. The other thing we built into the system is protections for the customers. The obvious error rules at each of the exchanges are.
What is the obvious error rule?
Sure. Each exchange has rules in place to protect participants from errant trades, whether it be a system problem at the exchange or a system problem from the members. And it allows the exchange to help the customers in times of a trade occurring at a price that was an artificial price due to a system error.
Okay.
The logic we used, actually, we built into the system the error rules to never allow a trade to occur at a price that would be deemed an obvious error.
So that's built right into the technology.
Right into the system. In fact, we went even further and built in what we call our one-tick protection, that if a marketable order comes in, an order that's marketable through the NBBO, So, for example, if the market's 2 to 205 and a 210 bid or a 220 bid or a market bid were to come into the market, in the case of the market order, what will happen is we'll trade to 205, which is the initial offer. If there's liquidity available at other exchanges at 205, we'll route on behalf of that customer to get that liquidity at the other exchanges. Once that liquidity is exhausted, we can trade at the next price, which would be 210, which we would do for the customer. On some exchanges, that market order would then trade through the next price. And what happens, not a lot, but occasionally, as the market makers sell the first price, sell the second price, as they refresh their quotes, they put an interim quote out there that's a wider quote. They may go no bid at $5, or they may be offered at $3 just to refresh and get a feel for where the market should be.
Right.
And some of the other exchanges will trade at that much higher price. We will never allow that trade to occur at that much higher price. Once we traded one tick through the market, that's the end. We will not trade that order at any further price. And we'll actually give the order back to the broker-dealer that entered the order with a notification that we're unable to determine a good price. If they'd like to resubmit the order to the MIAX, they're welcome to. If they'd like to send it to one of our competitors, that's fine too. But I'm of the belief that it doesn't make sense for me to print it on MIAX to my advantage and possibly disadvantage the customer. I always want the customer to have the most positive price experience possible.
Sounds like you're putting the floor officials out of business too.
We'd like to do that, yes.
Well, that's really, I think that's a good understanding of what you're accomplishing and developing here at MIAX. I want to thank you a lot for joining us today and wish you all the best, Shelly.
Thank you so much. We appreciate it.
It's time to break down the latest option strategies. It's time for Strategy Spotlight.
Joining us today from TradeKing is Brian Overby. Brian, thanks so much for joining us today on Strategy Spotlight.
Well, great to be here.
Now, tell our listeners, if you would, how you came upon joining TradeKing and what's your role there.
Well, as far as TradeKing is concerned, we've been in business now about 8 years. Me and 9 other guys were the founders of TradeKing, and we just started with the idea that we'd like to, give great option tools to the retail investor and do it for a fair price. Our motto actually is as simple as you can get. We just say, be good. And that's the goal of TradeKing overall as far as how we want to treat our clients. As far as the price, we don't want to nickel and dime. We give you a great service for a fair price.
Be good. I love it. Straightforward.
Yep.
And how about prior to TradeKing? I know you've been in the business for a long time. You've got a real passion for education. Tell me about some of your other experiences.
Oh, yeah. Well, yeah, I have been around, I have to admit. I've done my time at the Chicago Board Option Exchange. I also worked for Knight Financial at one point in time, just working with market makers as the director of education there, teaching market makers on option pricing and option models. And also have worked as a consultant for quite a few different firms, including Thinkorswim, which is now TD Ameritrade, and also Options Express.
Fantastic.
So, yeah, I've been in the business almost 20 years now.
Yeah, I know that feeling, Brian. And it's all good. It's all good. You know, you've taken the time, to write this really highly acclaimed options book, the Options Playbook. What motivated you to write that? And, you have a really unique format in the book. What drove you there?
Oh, yeah, definitely. Well, one thing we wanted to do is we want to try to make options trading as simple and a little bit fun, if you will, which is kind of hard to get the fun out, but there's a little bit of personality in the book. We tried to lay out the strategies where you have on each strategy, and there's over 60 strategies in the book, and we want to lay it out on a 2-page format. It was kind of tough to do, but want to give a good summary on what drives the strategy, the sweet spot where you want the stock to go, how it reacts to volatility changes, when time decay happens. And the biggest driver, I think, of the book is that whenever we first started, all these advanced strategies just kind of came out of the woodwork when option pricing became more and more tight as far as bid-ask spreads and the width of the spreads, and commissions started coming down. You have firms like us charging as low as 65 cents a contract with a little ticket charge. It made it feasible to do things like butterflies and iron condors and stuff like that. And when those strategies first came around, I always found myself, even as an options analyst, always wondering, gee, I'm doing that skip strike butterfly. Where's my break even again? And so my whole goal in writing the book was trying to make a very simple, quick reference guide that will give great detail and great insight as to, if I do this strategy, here's what I want to happen to the stock price, here's what I want to happen to volatility, here's what I want to happen as far as time decay. And I think we kind of accomplished that goal. We're already on our 20,000 print of the book, and we've sold close to that many. I should say sold/gave away. But yeah, things have been going well with it.
I think you did accomplish your goal. I've certainly read the book, and it really does lay out, as you say, close to 60 strategies in a really simple, crystal clear fashion. And after all, so many of our listeners and option investors can sometimes think that, options are confusing, they're very complicated. Kudos to you for really breaking it down to the point where, it is crystal clear and allows investors to kind of make a decision on what strategy which strategy they want to use based on, the way you laid the thing out. So well done. What year did you publish that, Bri?
Oh my gosh. There's two versions of it. The first copy came out about 4 years ago, and then we updated it about 2 years later. So the latest version is about 2 years old right now. Yep.
And again, to our listeners, if you're not familiar with Brian's book, it is called The Options Playbook, and it really is one to add to your options library. So
and Joe, I'd just like to mention, too, that we actually decided to turn it into a website. It was so popular as far as giving it to our clients that sign up for new accounts and also going out and selling it via Amazon. We decided to actually take all the text and actually make a website called theoptionsplaybook.com, which has been very, very popular.
Outstanding. Okay, so that's theoptionsplaybook.com.
Yep.
Excellent. Well, let's, I appreciate you joining us today and getting into a particular strategy, in our strategy spotlight segment. What I think you want to talk about is guidelines to buying options. And certainly there is a lot of art as well as science in the whole buy side when it comes to options. Why don't you start, with some of the guidelines that you use when trying to decide which options to buy?
Oh, definitely. This is something I am very passionate about. As a matter of fact, one of the most popular things that we have actually right on the Options Playbook website are a bunch of intelligence reports, we call them. And one of the topic that we're going to talk about today is one of the top 10 mistakes that I point out inside the top 10 mistakes intelligence report. And one of the biggest mistakes that I always see retail clients doing is really not understanding how time premium is affected inside an option contract. Where does it come from? Why does this option contract trade with this much time value in it? And so because they don't really understand that, one of my top 10 mistakes that I outline is the first time option buyer always has a tendency to go on out and say, okay, I like this stock. I think it's going to go up. So let's go buy an option. And what are they attracted to? They're attracted to the cheaper options. Why? Because you can buy a lot of them. So they like to buy that option contract without really understanding the dynamics of the pricing of that option contract. In other words, it's priced that way and it's cheap for a reason. So I always, whenever I talk about this topic, I always like to talk about probabilities, and a lot of people don't really understand that an option is priced the way it is based off of the probability of the underlying actually getting to that strike. if that makes sense, Joe.
It certainly does make sense. So those out of the monies that are less expensive have a lower probability to actually get in the money at expiration, correct?
Correct. And so that is why that option is priced the way that it is. So I went through and I did a couple of utopian examples. In other words, just looking at using a pricing calculator. And the biggest thing about retail option trading is understanding the theory to start with. You know, the real world, little things change, but if you don't understand the theory behind it, you'll never quite grasp why an option is trading for what it's trading for.
And your specialty is keeping it simple, so you'll explain that theory in a rather simplistic way for us?
Well, that's my goal. Let's hope that we can succeed. So in this realm, let's talk about a stock trading at $75, and we're going to look at a strike that's 5 points out of the money. So we'd be talking about stock XYZ, generic stock, $75. Strike is 80. And we're going to look at a 90-day call option. You know, this is an option contract that people, I've seen, especially beginning traders, that they'd be interested in. They're given 90 days for the forecast to be correct. They're looking at the 80 strike. And the first thing that you really have to realize when you look at that is that 5 points on a $75 stock, that's where the strike is at, right? 5 points on a $75 stock, that's about 6.5% out of the money. Now, you're talking about in this day and age, especially, that's a good move in a year, and you're hoping that the stock can make that move over the next 90 days. All right? So let's take that scenario, keeping that in mind and saying that when you're talking about options, the probability of that stock getting to the strike has a lot to do with why that option would trade for the price that it does. And in this scenario, we have option trading $1. Now, I want to walk you through a scenario, and I want you to think about this and think about probabilities and listeners at home, if you want, you can write it down. $75 stock, 80 strike call, trading for $1, 90 days to expiration. Now, let's do just a simple concept. Let's say we were right on our forecast. We got an 80 strike call, the stock went up. And let's say it went up 2.5 points, and it took 45 days to do it, right?
Got it.
Good?
Got it. So we leave 45 days to expiration, and the stock's moved up $2.
$2.50. So in other words, it's moved half the distance to the strike in half the time. Okay. All right. When we started, that option was trading for $1. So if you were working through in a utopian world, we're just going to look at price movement and time decay. We're not going to talk about other little variables. We're just going to try to understand the concept of these two things. If that stock was trading for $1, half the distance and half the time, what do you think it would be trading for as expiration or as we get to that 45-day time period? Well, the biggest thing, if you're going to, before you answer that at home or answer that on your paper, is to think, well, when we started this, what was the probability of that stock getting to 80? Well, as far as the marketplace was concerned, they said, well, the probability of it getting to 80 was worth $1. All right. Now we've spent half the time, and our forecast, we only made it half the distance. But when you think about it, the probabilities haven't changed on this call option at all. On the odds of it actually getting to that strike, nothing has changed considering nothing else in the marketplace has changed. So when you look at that, the option would be trading for exactly what it was. In other words, if I paid $1 9 days ago, half the distance to the strike, half the time gone away, the probability stays the same, and you'll see that that option will be trading for the same price, $1. So this is one of the things that a lot of people don't grasp, and they think, oh, I've been right on my forecast. How come I am not making any money on my call option? And the reason why is that when you started this, you didn't really realize that this stock needed to move 6.5% in 90 days. And that's very hard for some stocks to do. And so the option price is always going to reflect that dollar amount, and it's always going to reflect the probability that that option will actually get to that strike.
And then also, in addition to the probability, which you're focusing on, those aspects of theta and implied volatility, they come into play as well, correct?
And they do. And, we're talking, I got a very generic example. We're talking about a 90-day going to a 45-day, which, that's a decent option contract that people are attracted to. Now, those numbers would change a little bit if we're talking about a 14-day going down to a 7-day, because as you mentioned with theta, which is the Greek that tracks time decay, it accelerates as expiration approaches. So we're talking about a fairly generic example, but my whole goal is to try to make people understand that just because you're right on your forecast, buying out of the money options aren't always going to give you a profit. And here's part of the reason why. Now, you throw in different aspects of it, other things can change, volatility, other things, and that can throw the numbers off. But in a utopian marketplace where you're just talking about an out-of-the-money option that's fairly decent out in time, it moves half the distance in half the time, don't expect to be making a windfall on that option contract.
Well, how about if, do you want to talk in terms of the at the money or in the money and those probabilities and how that works as well?
Right. So then we go back and we talk about the value of an option contract based off of probabilities. And we talked about a 5-point out-of-the-money option on a $75 stock being worth $1. Now, using the same underlying, using the same dynamics of the marketplace, if we were going to look at a at-the-money option, that means the stock is 75 and the strike is 75, that option contract would be trading for about $3. Now, you can also think of it this way. That's what the option at marketplace is pricing the probability of that thing being in the money on expiration. So you're much closer to the strike. So because of that, you have to pay more. And what are you paying? You're still paying all-time premium, but that's what they think it is worth. Now, in that same scenario, where we go on out and we take that 90-day option, it goes to 45 days. Let's make the stock move the same distance, 2.5 points to the upside. Now, if we look at that scenario, nothing else changes. We don't worry about volatility, anything else. We just got a little bit of time decay. That option contract would be trading for $3.62. Now, in utopia marketplace, once again. But now you've just gone from break even on your forecast to actually being up about 20% or 62 cents on a $3 investment. So things change, but now once that option starts to get in the money, it's going to start to move one-to-one with the underlying stock. So you're going to get some bang for your buck. And whenever I talk to retail investors, I always think about not how many contracts can you buy. Oh, you should buy a 5-lot. You should always buy a 10-lot. I always like to look at, well, I have X number of dollars that I want to invest. Should I buy option number 1, option number 2, or option number 3? And I'm going to buy as many contracts as I can with my investment or my risk capital. And in this instance, if you bought the out-of-the-money option contract, in that scenario, you're actually just at break even, where if we go with an at-the-money, we actually have a profit, and a decent-sized profit at that on a percentage basis. And that's all the reason why people like to trade option contracts, right? It's the leverage that can happen.
Indeed, it is, and I love that approach. Start with the amount of money that you're willing to invest, as opposed to, how many options can I buy? I think that's a great approach.
And I think that's that big reason why people are attracted to that $1 option or that way out of the money option contract, because you can buy a lot of them. You sound great at a cocktail party, right? I own 100 of these call options. Well, anybody can. It's trading for $1. Yeah, the same type of scenario. But I think that's a big reason why. So yeah, I definitely like to talk about the amount of money you want to invest as opposed to how many contracts you can buy.
And how about, obviously the same thing relates to the in the money. Are there other aspects, in this top 10 list of biggest mistakes you find investors making that hammer home this idea of probability?
Oh, yeah. And also, the one thing that I will talk about inside the paper is the very last scenario that you mentioned, the in the money. So we take that same scenario, but let's move the strike. Stock's at 75, XYZ generic stock. Let's put the strike at 70. Now that option is trading for $6, right? We cut the time in half. Our forecast is correct. We go up 2.5 points. Well, that $6 option contract now goes up about $2.11, thereabouts, And that on a percentage basis is about 35%. So a lot of people don't even think. Now, if you're talking about the actual dollar amount invested, you go from scenario 1, where you did half the distance in half the time, and you break even. Scenario 2, you put about 20% on your money. Now we talk about this. We can't buy as many because there's $6 options, and some people would say that's an expensive option. But because of the dynamics of the marketplace and the way that it reacts as we get further and further in the money, we're actually up a higher percentage as far as the movement of the underlying stock and the option. So one other thing to mention about this is, in the scenario and in the utopian world, once again, it's about time premium and how that gets managed. And if you noticed, when we were 5 points out of the money, that option was trading for $1. That's all time value. And you go 5 points in the money, that option was trading for $6. But guess what? That's also $1 worth of time value. So as far as time premium is concerned, usually you go equidistant in and out of the money, you're paying the same amount of time premium. The only difference is that in the money option reacts much differently to the stock price movement than the out of the money option.
I think, Brian, this is why your book's so successful. It's why you've been in the business as an educator for so long. You bring a crystal clear explanation. I think for a lot of our listeners, this approach from a probability standpoint may be a new approach for them. So, really well said, and thanks very much. That's good stuff.
All right.
I think before we wrap it up, you've been in this business a long time. Do you have, a fun story that you may want to offer to our listeners?
A fun story as far as the option trading side, on the education side?
Yeah. One of your more entertaining situations.
Well, I can't, God, Joe, you're putting me on the spot right off the top of my head. I can't really think of a great little story. I definitely had many in all the travels and all the miles that I've put on going around teaching option contracts. But let me pause. Yeah, I can't. I'm drawing a blank right at this moment. I have to.
That's all right. And I would say the probability of that was very low, but that's fine.
Well, I mean, I do enjoy teaching options. There's no doubt. I've been doing this for many years, and I'm very passionate about it. I believe heavily in option trading and what it can do to the retail investor overall. So I always had a great experience and a great time in all the teaching that I've done over the years.
Well, you're very good at it, Bri, and I think you know that. So just want to thank you for joining us today on OIC's Wide World of Options, and we'll see you out on the road.
It's time to upgrade your options toolbox with cutting-edge trading platforms, devices, and information. It's time for tools, resources, and good reads.
In today's tools, resources, and good reads, we're going to talk about a form of technical analysis, the Elliott Wave principle. This technique defines market waves and allows for investors to target highs, lows, and changes in market direction. Now, at its core, the Elliott Wave principle defines primary market moves in 5 waves, while corrective phases play out in 3-wave countertrend moves. Ralph Elliott, an accountant, developed these analytical tools in the 1930s. This approach to analyzing the market is intended to identify extremes in investor psychology by identifying specific wave patterns. Elliott defined these behavioral waves in his 1938 book, The Wave Principle. His patterns are meant to define psychology and identify investor mood swings from optimism to pessimism. More recently, over the past 30 years or so, Robert Prechter Jr. has become the name most associated with the Elliott Wave. His book, The Elliott Wave Theory, was published in the 1990s. That's today's good read, The Elliott Wave Theory by Robert Prechter Jr. I urge you to consider investigating this unique approach to market analysis. That's it for today's tools, resources, and good reads.
It's time for a nostalgia break. It's time to take a look back.
In today's Looking Back, I want to look back at U.S. listed option volume for the past 10 plus years or so. Right now, the industry is averaging about 17 million contracts traded daily, putting us on a pace to exceed 4 billion contracts this year for the third year in a row. To put that 4 billion traded contract number into some kind of perspective, you should know 2004 was the very first year the industry traded 1 billion contracts in a year. So the growth over these past 9 years is really rather staggering. Why such growth? I personally point to a couple key factors. First, electronic access to the markets. This started in 2000 with the founding of the ISE exchange. Second, competition. Going back to the late 90s, option markets on an underlying option were only made on one exchange for the most part. Now, the advent of dual listing increased competition dramatically. That, coupled with the addition of new option exchanges, has also increased market participation and therefore competition. Another reason for the increased volume comes from the cornerstone of our business, that is the Central Clearing Corporation, where counterparty risk is taken out of the equation with the listed options product. Finally, and especially after the recent financial crisis, more and more investors are taking responsibility for their financial futures. Many investors are looking to listed options, and that is another reason for some of this significant industry volume growth. That's it for today's Looking Back.
You've been listening to the Options Industry Council's Wide World of Options. If you have questions about anything you heard on today's show, email Joe Burgoyne at options@theocc.com. Or you can call OIC's Investor Services at 1-888-OPTIONS. Interested in connecting with OIC on social media? Like the OIC page on Facebook. Follow them on Twitter at options_edu. Or join their group on LinkedIn. Thanks for listening, and be sure to check out our next episode of The Wide World of Options.
The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.